Okay, guys, in this video, I'm going to explain order blocks, breakers, and mitigation blocks. Okay, and into I'm going to delve deeper into fair value gaps. I know I've touched fair value gaps before, but I didn't really go that much into detail. So I'm going to um, break it down a bit more, and I'm going to teach you how you can incorporate it into your trading system. If you recall, when I taught or explained the dynamics of supply and demand, supply zone, demand zones, all those things. Okay, if you can recall, I told you that whenever you are making your entry, wherever, okay, whether it's a supply zone, a demand zone, wherever, any zone whatsoever, wherever you are making your entry, if you can recall, I told you then that it should always have a fair value gap. Now, why should it have a fair value gap? What's the essence? What's the importance of a fair value gap? Now, okay, I'm already explaining fair value gaps, all right? So let me just start with fair value gaps, okay? Um, well, let me explain other blocks and breakers, then I would explain fair value gaps. So, other blocks, breakers, mitigation blocks, it's quite simple. Okay, it's not difficult at all. It's not a concept that is difficult to understand at all. Okay, um, let me use this arrow to explain. Okay, other blocks is basically the last up close or down close candle before an aggressive move to the upside or to the downside. Okay, it's similar to supply and demand zones that I taught earlier on, but it's not the same thing. Okay, other blocks are not supply and demand zones. That's what you need to know. But if you understand the concepts of supply and demand zones, the way I explained it, and incorporated fair value gaps into it, and I told you then the high probability supply and demand zones. They should have the work best when they have fair value gaps, all right? But um, other blocks are quite different, okay? The simplest definition I can give you for other block is, if you are bearish or bullish, there's bearish other block, there's bullish other block. So you are looking for the last up close candle before an aggressive move to the downside. That is bearish order block. Now, bullish order block is the first um down close candle before an aggressive move to the upside. Okay, so let me go over it again. Okay, I think I mixed it up. Bullish, or let me say bearish order block, okay, is the first up close candle before an aggressive move to the downside. Okay, why bullish order block is the last down close candle before an aggressive move to the upside. Now, I used up close and down close because um I'm just basically just trying to simplify. Okay, it's more than just up close or down close candle. All right. What you just need to understand is sometimes when you narrow down to the low time frame, what appears as an order block on, let's say, 10 minutes or 15 minutes might end up being series of candles, okay, on lower time frame. So when you are using low time frame, you need to understand that when you have series of candles like that before an aggressive move to the upside, upward, when you have a down close series of down close candle, you have an aggressive move to the upside. Those series of candles, everything, okay, it could be two, it could be three, it could be four, everything put together is also an order block, especially on the low time frame. Okay, when you go to the higher time frame, those series of candles might end up being one single candle. Let's say, for example, on the 5 minutes, okay, when you go to the 1 minute, there might be like three or four candles. When you go to the 5 minutes, there might be just one candle. Okay, so it's not just the last implying that it is one. Okay, sometimes it could be two candles, it could be three candles, and so on. Okay, so what is the order block? Okay, so if you have, imagine you have something like this, price is moving up, and then um, all of a sudden break structure. Okay, this is a break of structure to the downside. All right, this, well, let me create a swing high first. Assuming you have a swing high, okay, and then the swing high was taken out. That's a liquidity sweep. Okay, the swing high was taken out, and then you now have an aggressive move to the downside. Okay, the move has to be aggressive. Okay, it has to be an aggressive move to the downside that leaves behind a a fair value gap. Okay, so if it leaves fair value gap behind and the displacement is energetic and it takes liquidity before it breaks structure to the downside. Okay, the first or the series of up close candle you have here before that move to the downside is the order block. Okay, that's the order block. All right, and like I said, the order block is only valid if there is fair value gap between this swing high and this swing low, and if the move from this swing high to this swing low is energetic, like it is aggressive, it is an aggressive move. So if price should return back to those candles, usually you get a significant rejection. Okay, so that's the bearish order block, and it's um vice versa for it's vice versa for bullish candles. Okay, so if price is coming down, okay, forms a swing high, sweeps the swing low, okay, that's liquidity sweep, break structure aggressively to the upside. Okay, when you have, don't forget that the candles you see here, these would be bullish candles. Okay, so the down close candle that you have before this energetic move to the upside that leaves behind an imbalance of fair value gap, okay, that is your order block. Okay, so something like this. So when price comes back there, you usually would expect to see a strong reaction. Okay, so three things are important as far as order blocks are concerned. Number one is there should be a liquidity sweep before the break of structure. Okay, it's basically all those things that I've explained to you using the concept of supply and demand zone, but other blocks are not really supply and demand zone. When you are marking out supply and demand zone, you don't need to see a fair value gap. Okay, so that's how they are different. Supply and demand zones are basically where institutional traders are entering the market, where um, they are looking to mitigate their orders and all of that. So it's really quite different. So plan and demand zone might, at the end of the day, might just simply be where there is a accumulation of orders and there is an aggressive move away from it. So it's different. Okay, that's what you need to know. It's different from supply and demand zones. Okay, a lot of times you would find other blocks inside supply and demand zone. What I thought as supply and demand zones. Okay, so let me give, for example, this is an example of um other blocks from this all this up close candle. Okay, this is 2 minute time frame. When you go to 10 minutes or 15 minutes or 1 hour time frame, you would see that the whole of this candle might be one single candle. So this right here is the other block. If price should come back to this level, you can see that this energetic move that broke structure to the downside. Can we call this another block? Yeah, it's another block, but um there is liquidity sweep, but it wasn't immediate break. Okay, it wasn't an immediate break. Okay, so there's liquidity sweep here, okay, and then we have a break of structure, okay, after it bounced initially from this other block. Okay, so this is also another block. Let me show you here. Price forms a swing low, forms a swing high, liquidity sweep of the low, then break structure to the upside. Is there imbalance? Tiny little bit of imbalance. This is not the best of that block really. There is a little bit of imbalance here between this candle and this candle. Okay, just a little bit. Maybe if you go to the 1 minute time frame, we might see imbalance as well. So as price, you can see the reaction was not even that significant because number one, this move is not really energetic enough as far as I'm concerned, and there is a small, very tiny fair value gap here and here, but it's not significant enough. So this down close candle is actually another block, but it's not a high probability other block because of those factors that I have mentioned. So when price returns there, you can see that reaction before it then continues down. Okay, and this is another one right here. Okay, you can see this candle, this up close candle before this energetic move that broke structure. You can see the fair value gap that it left behind. So from here to here, that is your other block. Okay, or you can even use this candle or this candle. So basically the up close candle, okay, usually most times when price retraces, it's going to retrace into another block. Same thing here. Energetic, this is a typical example of the kind of energetic move I'm referring to that leaves a clear and obvious fair value gap. So these two candles right here, that is the other block, okay, and this up close candle here as well, that is another block. All right, so basically you are looking at the last up close candle before an aggressive move to the downside for bearish order block, and for bullish order block you are looking at the first down close candle before an aggressive move to the upside. So when price retraces back down to that other block, you would usually see um, a significant reaction. Okay, so that's other blocks. Now breakers are, so let me just use one last illustration. If you understand what I explained about supply and demand zones, um, other blocks are more or less like the extreme zone. Okay, they are more like the extreme zone. Now let me explain breakers. Breakers are formed when, assuming price forms a swing high, breaks the swing high. Okay, there is also liquidity sweep, obvious liquidity sweep, especially when you have equal highs and all of that. So breaks it and then breaks downward. Okay, the breaker is this, the whole of this price leg, everything here like this. That is the breaker. Okay, breakers are more significant when there is a liquidity sweep, when there is an obvious liquidity sweep. Okay, again, the move downward should be energetic. It should also leave fair value gap. Okay, that's what makes it valid, makes it high probability. So usually when you look at this swing high and this swing low, when you look in between, you see series of candles. A lot of times you see that to use the whole of this as your stop loss might be a little bit too wide. So personally, I like to refine it. I refine it to the um, in this case now we're bearish, so I'm going to use the bearish candles alone. Okay, if there are bullish candles, I remove the bullish candles and then I narrow it down to the bearish candles just to like reduce my stop loss percentage, okay, so that I can maximize my RR. Okay, so that's order block. So you expect that when price taps back into into the breaker, rather I saw that block into the breaker, you want to see um a rejection from that breaker. Okay, so this is what you refer to as a breaker. Let me see if I can find some examples here. um After an obvious liquidity sweep, yep, this is a good example. Okay, so price formed a swing guy, forms a swing low, sweeps it. If you look to this side, okay, this is actually sweeping the previous day high. So there is an obvious liquidity sweep, all right, and then there is an energetic move to the downside. Is it leaving any imbalance? You can see the imbalance like left behind. That's what you want to see. Oh, what is going on? Um, I'm not quite sure what is wrong with this. Okay, I think I was trying to show some examples here. Okay, yeah. So the whole of this price leg, actually, the whole of this price leg from this swing high to this swing low is your breaker. Okay, but like I said, for bearish breakers, I like to refine mine to, for breakers like this, if you are bearish, I like to refine mine to the bullish breakers. Okay, more like when you look at this, now this when you, if you are going up, one of the reasons where you can refine, if you are going up like this would be your um other blocks. Okay, ideally you would expect that the other blocks should hold, provide a reaction when price is coming back down. Okay, so you can view breakers as other blocks that didn't hold, okay, that failed. So you can see this more like a kind of a flip, okay, maybe like supply and demand flip, okay, or resistance, support and resistance flip. So this, before this energetic move to the upside, this, of course, you can see that these are the down close candles. So these are your other blocks, okay. So you can view breakers as other blocks that failed to do their job. When price returns there, it it flips um like what it's meant to do normally. Okay, it has now flipped the kind of reaction that you are meant to get ideally. Under normal circumstances, these other blocks are meant to provide a push to the upside. Okay, so now that the price has broken down below, then there is now a flip from bullish to bearish that block. Okay, so this price leg to this price is, I'm using this to make it simpler for you, but ideally your other block is from this area, from here to here. Okay, from here, the whole of this area, everything here, from this swing high to this swing low, that is your breaker. Okay, but I like to refine my own to just this candle. Sometimes I may even use the first two candles, okay, if I'm convinced that price is not going to go down. Okay, so this is also a, this right here is another block, actually. Okay, down close, up close candle, when price is bearish, coming down like this. Okay, up close candles you have like this, they are, I knew something was wrong. Yeah, I was sha confused. So I inverted the chart initially. Okay, so we are looking at the up close candle. Okay, if we are intending to go up, okay, if we are bullish, I'm narrowing my or refining my breaker to the these three consecutive down close candles. Okay, instead of using this and this. Okay, I like to refine my own to the bullish breakers. Okay, so I hope that is not confusing. I had the charts inverted initially. Okay, but basically your breaker is when you have a swing like this. Let me just explain again. A swing like this, there is a sweep of liquidity, an aggressive move to the upside. From here to here, that is your breaker. Okay, you can refine it if you are looking at bullish breakers, you can refine it to the bullish candles. If you are looking at bearish breakers, you can refine it only to the bearish candles. Okay, so this is also another block. See from here, this is the down close candles. Price goes up, price return back into it, price moves up. This is another order block, down close candle, price drops down and you can see the imbalance that are there. Okay, so this is the only example of breaker I can see here. Let me see if I can still see more. Okay, this is also another example of a breaker. Okay, this is price makes a swing low, rallies up, energetically breaks down. Okay, so from this swing high to this swing low, that is your breaker. Okay, so price taps into it and then sells off. Okay, you can see sells off. Okay, so that's breaker. Now mitigation block is when there is a swing failure, right? So in this case you have a high, a low, a lower high, and then price breaks down. Okay, so the difference between this and the difference between mitigation block and breakers is that breakers would sweep liquidity like this, while mitigation block would be a swing failure like this. Okay, so this was supposed to make a higher high, but it failed to make a higher high and instead it breaks down. Okay, so that is the mitigation block. So from this low to this high, if price should come back there, you expect to see a sell-off. Oftentimes, both breakers and other blocks would overlap with, both breakers and mitigation blocks would overlap with other blocks. So you oftentimes see some kind of other blocks here as well. Up close candle, okay, we are bearish. Okay, so that's, um, let me see if I can still see more examples of, um, okay, this is another example um, of breakers. Okay, price forms a swing low, forms a swing high, sweeps the swing low. This is a combination of both a breaker and a mitigation block. Okay, so we see an energetic break of this low that formed. Okay, if price should return back to this area, okay, so let me just mark it out. If you want to mark out your breaker from here to here, this is your breaker. Okay, you can see how price kept hitting it and was unable to break down, and then you see um, a move to the upside. Okay, so this is your breaker. Okay, from this, what do I do? From this high to this high. So you can refine it sometimes. Yeah, personally, I can't use this for my stop loss. It's too large. A lot of times I like to refine it to maybe the first two candles, or and at times I've been stopped out too, But then I don't mind. I just don't like having stop loss that is way too wide. This is way too wide as far as I'm concerned. Alright, so and if you want to look at the mitigation block here, this is a mitigation block. Pricing come back to the mitigation block though. You have this, you have this. This is supposed to make a lower low. Instead, it makes a higher high. I mean a lower high, I mean lower low. Rather. Instead, it makes a lower, a higher low, okay, a higher low, and then energetically breaks this high. You can see strong and impulsive move to the upside. Okay, price didn't come back to this level anyway, but if price should come back to this level, expect to see a push to the upside. Okay, like I said, from here to here is your mitigation block. From here to here is your mitigation block. Like I told you that most times price they would often overlap with other blocks. Can see that this down close candle before this aggressive move to the upside, this area, this is also, this is another block, and you can see that it is overlapping with this mitigation block as well. Here, this is a breaker. Okay, this is a breaker. Anyway, that's a breaker. So, I hope you understand. It's really quite simple. The difference between a breaker and mitigation block is the fact that breakers would take liquidity to sweep liquidity like this one, takes liquidity from here and then moves up. Why mitigation blocks would fail to take liquidity before it breaks structure to the upside. Okay, and like I said, most times you see that they overlap with other blocks. All right. So if you don't still don't understand, if you still have questions, you can always ask on the Telegram group page. Right. So let me go back. Let me go into fair value gaps. Okay. Now what I just want you to know about fair value gaps is that um, they can oftentimes act as support and resistance. Okay, if there is a liquidity sweep, if there is a sweep of buy side or sell side liquidity and there is break of structure, market structure shifts, um, and you see fair value gaps, then those fair value gaps can often act as a form of resistance. Okay, this is an example here. All right, so you see the price, we have a swing low, a swing high. This is another swing high, swing low, then price energetically broke through this swing high. And you can see the fair value gaps that it left behind. If you mark out the fair value gap, okay, you can see this gap right here. Okay, the gap between this candle, this candle, this candle. Okay, so this is a three candle formation. So you can place your entry anywhere inside of this fair value gap and use the low of the first candle as your stop loss. Okay, so this is something I basically want to explain. Okay, so you can actually use the fair value gap itself as a form of support and resistance. You can place it your order anywhere in between this fair value gap, or you use the high. Okay, if you don't want to miss the order, the high, your stop loss would be at this candle low or this one. Okay, let me see if I can still get some other examples. This is another one right here. Okay, we have price took liquidity. Okay, this is buy side liquidity, and then energetically broke below this low. Okay, is there fair value gaps? Yes, you can see there is a gap between this candle and this candle. There's a gap there. Okay, so if you are going short and maybe you miss your entry somewhere around here, you can place your entry inside of the fair value gap and use this high as your stop loss. This the high of the candle, this candle or this high here as your stop loss. Okay, let me look for more examples. Okay, this is still even more another example. You have a swing low, a swing high. Did it take liquidity? Yes, it swept liquidity from this high just a little bit and then energetically broke down below. Where's your fair value gap? This is fair value gap is this one right here. Okay, so price rallies into it. Like I said, your stop loss will be this candle or this candle. Okay, and then it sold off. Okay, um, this is another example. You can see we have this gap between here, this candle and this candle. Okay, you can place your order anywhere here and your stop loss will be on this candle or this candle. Okay, you can see this is a swing low. Price energetically broke below the swing low and then price rallies into. Now, if you feel like, okay, where should you place your order? Sometimes you can just look for the midline of the candle. Okay, so you want to like refine it. If you feel like this is too big, if you want to place your entry, you can place your entry at the midline, your stop loss, and this high or this high. Okay, and you can see the sell off that happened after. Okay, and lots, and lot of examples. So this is another one here. You have this swing low, this swing high, price energetically broke down below, leaving behind fair value gap. You can see this is gap between this candle and this candle. Why again place your stop loss, place it on this high or this high. It's always better you place it on this high. Usually always better. Okay. So price taps into it and you see the sell off that happened afterwards. Okay, this is also a gap, fair value gap. All right, so you can see price taps into it and you see this sell off, right? Why is it fair value gap? Because it formed this is a swing high, this is a swing low, this is a swing low. It took liquidity from buy side, um, it took sell side liquidity, energetically broke above this swing high, and then have these fair value gaps and price came back into it and sold off. You can also see fair value gap between this candle and this candle. Okay, price taps into it. Like I said, you want to use this low or this low. Okay, like I said, it's always better to use this low. Alright, it's always better to use the low of the first candle that forms the other block. Okay, so generally you have three candles here. One, two, three. Okay, it's a three candle formation. One, two, three. Okay, the gap between this candle and this candle, that's your fair value gap. So you want to use the low of the first candle as your stop loss or this swing high as your stop loss. Okay, you can see price rallies up after. Um, so basically what I just want you to know with fair value gap is that you can use it as an entry in code. Okay, you can use it to as an entry point if you don't want to miss a trade. A lot of times price would oftentimes reject from the other block, especially after there is a sweep of liquidity and then price energetically breaks structure to the downside. You can see from here again, your stop loss will be here. Okay, price breaks down. This is another fair value gap right here. Okay, so you can place your entry anywhere inside of the fair value gap. Your stop loss will be on the first candle. Okay, one, two, three. This is the gap between this candle and this candle. Right, your stop loss will be somewhere here. Okay, so you can use fair value gaps as entry point. That is basically what I'm trying to explain to you. Okay, this is another example. This is fair value gap here. Okay, your stop loss will be here or this swing high, first candle or this swing high, whichever one you are comfortable with. All right. So like I said, all of these things I'm explaining to you, other blocks, breakers, mitigation blocks, they are all on ICT YouTube videos. Okay, there are lots of videos. I mentioned, I told you guys, um, the first time I created a Telegram group in ICT is like the University of Price Action. A lot of the things I know, I learned from him. Okay, um, talking about price time and price theory, I mentioned it to you guys before. The Q zones, okay, the Q zones, time and price theory, breakers, other blocks, mitigation blocks, vacuum block, proportion block, all those things. I don't want to see. I don't want. I want you to make. I don't want you to get confused and overcomplicate things. Okay, that's why I gave you the most simplistic approach to trading as far as I'm concerned. It's simple, it's straightforward, but its limit, okay, you won't be able to function effectively in any market. You won't be able to function effectively in any kind of market. But if you want to have the deepest understanding of price action, I would really recommend that you go to ICT videos and start watching them. Okay, you can't, it will take time, it will take a lot of time. Videos are much. You just recently completed um a mentorship, a free YouTube mentorship that started like 6 months ago or last year, I think. And then there are about 41 videos in total. Each video is it's about an hour long. So we're talking about 52 hours for you to complete the video. So if you can spare the time, I tell you, if you can spare the time to go through those contents and you take notes, you back test what it teaches, your view of price action will completely change. Okay, the issue is if you don't backtest, if you don't try those things, if you don't go into your chart to like check those things out, collate the data, it will mean almost nothing to you. Okay, that's the problem that a lot of people are having with ICT mentorship videos. And I had the same issue initially as well because it was just too deep and it was confusing and um, I was overwhelmed, okay, more like an information overload. So just know what you are looking for, okay, and cherry pick the videos you want so that you don't get confused and just keep it simple, okay? Just keep it simple. If there's anything particularly that I'm going to recommend, I will recommend just go through his 2022 mentorship videos. Okay, it's quite he intentionally made that simpler and it's not as complicated as his previous approach to price action. Okay, so try and go through it. Okay, try and go through it. You would understand much better a lot of the things I've been trying to explain to you to begin to make a bit more sense to you guys. It will take you time. It will take you time, a lot of time to actually go through all of those videos because it requires work. Okay, it requires work. It requires that you do certain things to actually understand. You need to go into your chart, check for certain things, check for certain situations to actually understand. So it's not something that you can just go watch and then just watch and you think you have understood it and that's it. No. Okay, so just encourage you, try, please try. It will really help you guys. All right, so that's it for this video. Before the end of the week, I would make another video on time and price theory, and I'm going to really explain the Q zones and how I usually look at my I usually take my entries, okay, and maybe touch on news events and how to trade them, okay, because I'm currently doing a back test on news event based on what I shared on the group page, and what I'm seeing so far is absolutely mind blowing. It's absolutely ridiculous, okay, absolutely ridiculous. Okay, I can't just wait. I can't wait to start trading them. Normally, I used to avoid the news previously, but based on the understanding of what I know and what I've seen from my back test, the news is actually what I should be trading. Okay, imagine something that have a hit rate of almost 100% every single time you trade it. Okay, it's crazy. I don't trade in news. I don't really trade in news previously, but I'm still back testing. I'm still collating my data. The things I asked you to do to go into your chart and check what happens before the news, where does price go to after the news, how long does it take before it moves um from the time of the news release to its eventual destination. Those things, just study your chart, check them, see if you're able to identify any pattern and note them and share it on the group page. Okay. So that's it. Hopefully this month, I mean this coming month, we'll start the challenge. I am still not quite sure about crypto yet. Okay. I'm not There are many things I would love to see in crypto price action that I'm not seeing, and I'm not. The reason why I'm actually even considering crypto is because most of you guys trade crypto, and personally, I can't remember the last time I traded crypto because the price action is just terrible. It's just shitty. It's not. It doesn't respect those things I would love to see. For example, we are talking about kill zones, the low or high of the day forming during London kill zone. If you are bearish or bullish, all those things you don't see them in crypto, okay? Or even if you see them, they're not consistent, but you see them every day, every week in forex, in indices, in stocks. See them. So crypto market is not an ideal market, it's not a financial market, and I'm trying to avoid trading it. So I'm still not decided yet. But um I'll let you guys know. I'll let you guys know what my eventual decision is. Okay, so if you have any question regarding what I've taught or anything whatsoever, you can always ask on the Telegram group page. Alright guys. Um Take care. It's another time.